Hello, everyone. It's Ted Bauman here with another one of my YouTube videos. Today, I have a special treat for you. I have Jay Hatfield, who is the CEO of InfraCap. I'm going to let him tell you what his company does, but he's active in the ETF world. In fact, I hold some of his company's ETFs, just as a disclaimer. I'm not getting paid for this. I just find it very, very interesting what these guys do and their particular angle at the moment on the markets. And as you know, I love income, and that's what his products are all about. Jay, how are you doing today?
I'm doing great. Thanks for having me on your channel, Ted.
Cool. Tell me a little bit about your background, your company, and what it is you do.
Well, I'm from the West, from California originally. Went to University of California, Davis, majored in economics, CPA from Ernst & Young in San Francisco, an MBA from Wharton in Philadelphia in finance with distinction. And then the last 34 years, I've been working on Wall Street here in Manhattan. About half of that time as an investment banker doing utilities and energy and MLPs. And then the remainder, 17 years on the buy side, working at hedge funds, most notably Steve Cohen's SAC Capital. He's the owner of the Mets, ran $1 billion fund. Then I launched my own firm, launched an MLP, took it public in 2011 with an ex-client, Mike Krimble, trades New York Stock Exchange. And then over the last 9 years, we launched our 4 ETFs.
Great, great. And that's all under the InfraCap umbrella, those 4 ETFs. Yeah. Now, before we talk about what makes your approach to your ETFs different from everybody else's, just give us a basic tutorial on preferred stocks, because that's your bread and butter, right? Now, you've sent me some very interesting graphics, and I'm going to flash them off the screen that shows where preferred equity sits in the traditional capital structure. So walk us through that.
Well, so you have 2 of our 4 funds are preferreds, and that's not an accident, is that we love the preferred stock asset class, and we're big investors in it as well. We own a lot of our own ETFs.
Right.
So we're true believers. And the reason that we like the asset class, and we're focused on the what's known as the $25 preferreds. What's great about that is they trade on the stock exchange, usually New York Stock Exchange. So retail investors can access it, but more importantly too, when we trade them, we can split the bid-ask spread. You know, we can use our algorithms and our trading system to split that. If we're trading, there's $1,000 preferreds that are traded by the street, and they almost will never let you split the bid-ask spread. So you're really paying a lot to get in and out of that. So if we can split the bid-ask spread, there's no trading friction. But what's more important about them being listed is that since they're listed, almost all of the issuers are also listed. And we think that that's really critical because public companies care about their credit rating.
Yes.
They tell their boards, look, we're going to be BBB rated. They tell rating agencies, they tell their counterparties, in other words, their B2B trading counterparties, because almost every company has credit from other companies, that they're investment grade. So they're loath to do anything that would hurt their rating. And the worst thing one of the worst things they can do is suspend their preferred stock dividends.
Right.
And so instead of doing that, they'll reduce their common dividend. They'll sell assets. If they need to raise capital, they might sell investment grade bonds if they are investment grade. So these public companies are great long-term credits, partly just because that's their objective, is to be a good credit. Whereas private companies don't have that. They often just want to take cash out and pay it out to their private equity shareholders.
Right, right. So, and of course, preferreds being a hybrid of equity and credit means that you're actually one step above the common equity holders in the pipeline. So they really are, and this is why I love them too, because they are safe forms of long-term yield that don't come with quite the same variability, I think, as you could say, as debt markets. But they do provide that excellent yield. Now, you pointed out something that I didn't know a while back when we spoke, and you mentioned that preferred securities have one of the lowest default rates, particularly compared to high-yield bonds. What's their track record on that?
Yeah, so we found data from Moody's, and And it's great to have the data because I kind of knew this just having traded them for the last 20 years.
Right.
But the default rate is similar to investment grade bonds. It's about 0.3% annualized over the last 30 years. So that includes the financial crisis, which is important.
Right.
And investment grade bonds are 0.10, but of course you get a lot more yield with preferred. So it's more than paid up for by excess spread. Then high yield bonds have a 4% default rate. So it's almost 10 times as much. Now, to be fair, when a bond defaults, it's going to have higher recoveries than a preferred.
Right.
And that's, though, one reason you mentioned active management. We do think active management is important to manage three risks. You have interest rate risk and default risk, and then also call risk.
Right.
The good news about $25 preferreds, they're listed, so you can trade them, but they almost all they're callable at par after 5 years. And so some of the big passive ETFs, they will hold preferreds trading above par that are currently callable.
Right.
So if the company decides to call them, they lose money.
Right.
And so we're able to sell ours. We might hold it at 24.50. If it trades at 25.50, we're like, sold to you, ETF.
Mm-hmm.
And it's not like there's any scienter or bad acting going on. It's just that they're getting inflows and their market makers are going to try to buy these preferred. So we sell it to them.
Yeah.
So we're able to take advantage really of the passive funds and manage those three risks. Like for instance, last year, we really a year and a half ago, we got rid of all of our low coupon preferreds because they have higher interest rates. Another good data, maybe we should put it in our preferred piece, is that a 4% coupon preferred has a duration of 22 years. So it acts like a 22-year bond in terms of interest rate risk. But a 7% coupon preferred has a duration of 12 years. So it acts like a much shorter bond, and so it has less interest rate risk. So we're able to manage those risks. And then if we do get nervous about a credit and think that they might, have a significant chance of bankruptcy, then we'll sell it, hopefully, not at 0, but at 20 or 22, and avoid sort of, the potential downward spiral, because the recoveries, that is the risk. And it's a fair rule of investing. Without risk, there's no reward. So you should know what risks you're taking. So you're taking those three risks I mentioned. And so in a default, you would do worse than a high yield bond because you get de minimis recovery, whereas a high yield bond might get 40 cents on the dollar or 50.
Right. Right. Now, from what I can see from the data that you sent me, your approach, which manages preferreds actively, actually outperforms the passive ETFs by quite a lot. I believe the most recent figure is the overall yield is about 7.25% versus 5.85% on the passive side. Now, you've done that, by managing things actively. But tell us a little bit about, what makes preferreds so attractive right now. Obviously, we are in a situation of interest rate risk. We've seen the fastest hiking cycle in many people's investment lifetimes, actually. So where do preferreds fit in right now?
Well, our fund's slightly different than the broad index in that we're probably just a little bit more sensitive to the stock market and a little less sensitive to interest rates.
Right.
You couldn't really tell that last year because they were both terrible. Both those markets were terrible. So interest rates were skyrocketing and the stock market is way down.
Right.
So, but initially we were outperforming a lot because the market was holding in pretty well and the bond market was selling off. But so our risks are slightly different than most preferreds. But the other things that distinguish our fund is it's better diversified by sector. The index funds tend to have 65% financials. Right. And they're also cap weighted. And so in other words, if there's a gigantic issue, or like some of the big investment banks like Morgan Stanley who issued, $3 billion of preferred, well, then that'll be their biggest holding. But what's the likelihood that that's the most attractive preferred in the sector is that gigantic one. And in fact, we think that when you're managing a preferred portfolio, and this is an advantage of not doing it yourself, although, we think that's an attractive thing to do as well, but you can mix, is that it's better to have a diversified portfolio because you kind of don't always know exactly which companies are going to get in trouble. So if we have 102 companies, 170 issuers, so no one company is going to hurt the fund significantly. Right. So we think diversification is important, but every company in there we do think is a bit of an idea. We think it's undervalued, and so a lot of our positions, even last year, which is a terrible year, actually got called away. South Jersey Industry was a great utility, very attractively priced, mandatory. So we sold that at a gain, and then a substantial gain, and then we recycled it in low coupons. But to get more directly to your point, the reason why now is particularly attractive time to buy preferreds is that on average they're trading about $20, and they're callable at 25.
Right.
If we had this conversation like a year and a half ago, I'd say, look, this is a great yield instrument, but there's not a lot of upside because, all these securities are callable at par in 5 years.
Right.
And, they do trade in the stock market. So if the stock market's terrible, they're likely to trade off. But here, the risk reward is better, particularly from a capital appreciation perspective, because yes, could they trade lower? If the stock market goes lower, they will. We're pretty bullish about the stock market, but if it does, it will go lower. Not as fast as stocks, most likely. Right. But if the market's just somewhat stable and interest rates stabilize, we think they're going to go to 3, but if they stabilize around here even, then the chances are they're going to do exactly what they've done over the last 30 years, is they drift back to par.
Correct.
In fact, that's really where we got all of our capital, and we're able to launch an MLP in our firm and hold a lot of our own ETFs, is that we bought a lot of preferreds in 2009, not financials, but actually REITs, because it was easier to analyze the credits and they didn't have the overhang from the Federal Reserve potentially taking them over. And we, made, ridiculously good returns. We're not going to have that level of opportunity because some preferreds are trading at 5 at the time. But, an average 20, if it does return to par like they normally do, you get sort of 25% capital appreciation and a 10% yield while you wait.
Correct. Right. And of course you get, the yield to call calculation gets better, when you get those low entry prices. And I think that's one of the critical things I like about preferreds is that the average investor panics. They look at the market going down, they think I should sell everything and move to cash. And then they sell preferreds, which really are far less risky than the common equity of most companies. So if you can come in and buy them at those low prices, then you get these amazing yields. And that's one of the reasons why I like them so much. Now, tell us a little bit about your industry, the weighting. You mentioned that you have a different pattern of the way that your ETF holds different companies. For example, I'm looking at your list, you're at 50% in financials versus 70% for the rest. That you mentioned the cap weighting, but are there other reasons why, for example, you're into the pipelines, the MLPs and the real estate besides?
So most of our the credits we're involved in are asset intensive industries.
Right.
So it's a good rule if you're going to lend money to someone, even though this is preferred, you're kind of de facto lending them money. It's good to do it on modestly levered asset intensive companies. In fact, of that 50% financials, a lot of those are mortgage REITs,
right,
which do have substantial collateral and tend to be, not always, but tend to be less levered than financials. Now, financial companies, if they're properly run, also have assets. It's just they run, 9-to-1 leverage, so that makes them slightly nicer. But they're monitoring that. They'll issue equity. They get regulated. So we don't hate financials from a credit perspective, but we love situations like a great pipeline company that we've been following for 10 years because of our MLP ETF. We know the credit's solid, and the preferreds are yielding 8.5, 9. And also you get some tax advantages by holding MLP preferreds. You actually get the same tax advantages you would if you hold the common. Right. So if you look at every company we own, it's asset intensive. It's usually old economy. We have no tech stocks as credits. And so even if there's a bad market or even the company has some problems, there's going to be assets there that are going to ultimately pay off the preferred in most circumstances.
Hence that very, very low default rate that you found out from the
Right.
Moody's data. Now, before we go, I just want to, you've got 4 ETFs. You want to walk us through just very briefly what each of them is and what they're meant to do?
Yes, that'd be great. So our flagship fund, our largest fund, is PFFA. There's an index fund. The biggest index fund that's passively managed is PFF. So we added an A, which is allowed, surprisingly, to their ticker. And so it's actively managed. And that's where we can really take advantage of really the ETFs, the passive ETFs, sell above par, recycle below. If we do that well, we should, by the way, be able to increase the dividend slowly, because it's preferred slowly over the years. Because if you sell something at a gain at a 7 yield and buy something below par at an 8 yield, you get more income.
Right.
And so that's really kind of our flagship fund. It's the most liquid. PFFR is for real estate. As I mentioned, we made a lot of money. It's REITs are actually great credits. I was trying to describe this on Bloomberg Radio. They're less levered than a building. The bankers, I found this out being a banker. I pitched a REIT to one of my clients, and the REIT specialist said, well, you can't lever it 60%. It's got to be 40, because we sell it to retail. It has to be full cycle. Well, that's good both for the equity holders, but particularly the preferreds. So REITs are really good credits. So we have a whole fund that is down, just like PFFA, because people are kind of panicking about REITs, which are still solid companies.
Yep.
It's PFFR. And then that also gets some tax advantages because you get a 199A deduction. And then we have AMZA, which is our pipeline fund. Yields right around 9%. Fully diversified. It's a corporation, so you get a 1099, has excess tax basis, which makes it one of the better ways to invest tax deferred. And then our most recent fund is ICAP. It's held up very well because large cap dividend stocks have outperformed the market since we launched it. We run modest leverage and buy preferred, so it has an 8 yield right now. And that's also a fund where all of our funds we should, except for PFFR because it's an index fund, over the long term, the target at least would be to raise the dividend because the underlying companies are raising their dividends, so we're able to pass that along. So those are the funds. They're all yield oriented,
right? And
we think all pretty timely, given that the market's still dicey. It's probably not the time to go all in on just tech stocks. Gamble. It's better to be a little more conservative right now.
Absolutely, and that's the message I've been putting out all year. In fact, I'm looking at PFFA on my market monitor. That's the one I own. And look, the forward yield I think is about 9.7, 9.65 right now.
That's right.
That's outstanding. But look at the YTD appreciation. I mean, you're up nearly 12%. On the actual value of the fund. I mean, this is something that you want to own, folks. And like I said, I'm not getting paid to say this. I'm saying this because this is an investment style that has worked for me. The bottom line is you're looking for yield, and especially in an inflationary environment, if you can get yield that beats inflation, that's your first milestone. And after that, you wait for the rest of the market to figure out how you're doing that, and then they pile in and push up the appreciation, as you've explained with these underlying REITs. Well, thank you very much, Jay. It's been good talking to you. I'm going to flash up a little screen that shows how folks can look at your ETFs and go to your website. And so hopefully some people will check it out. These are all tradable tickers, folks. You'll find them all there. And I, of course, will flash up the names of those tickers as well before we go. Jay, thank you very much. I hope to talk to you again soon.
Thanks, Ted. It was a great conversation. Great to be on.
Cheers. Bye-bye.